You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
Hello, Jim.
Well, metals and mining prices really seem to be taking off. Where is it going to go, and what should we do?
Well, nobody can predict the future, but we've been talking about this for quite a while, about how the mining stocks and the metal prices have been stretched beyond what we would normally expect on the downside, and you have to expect some kind of a snapback. And so now we have what's been going on for the last couple of weeks, really, an amazing turnaround in the mining stocks, which have been 2 standard deviations below what you'd expect in relation to the metals, and they're going vertical this morning. But it's real easy to get caught up in all this, and some people that didn't buy lower now are going to buy because prices have gone where they thought they might. And now we have information risk, which was what we had before with prices lower, being replaced by price risk. So the volatility, I think, is going to continue to be really pretty large in both directions. And the key, I think, for us is to try to remain calm and not lose our heads or our balances.
Well, the prices might still look attractive. You have to make sure you're buying the right one.
That's true. And, some of these have gone up. Some of these stocks we've talked about have gone up 50, 60%. One little one that I referred to a month or so ago that we were talking about at 94 cents is now trading at 231 this morning. It's a producer up north for silver. And that you can find dozens of other stocks who've done the very same thing. And so I think, for me at least, I'm looking at why this is happening, and Mr. Market never tells us why until later, so we won't know all the underlying reasons. We can speculate about it, so to speak, but the obvious flashpoint is the Middle East, with oil up $3 a barrel and gold is a safe haven, this type of a thing. But the reality is the fundamentals of the market are turning around, and the tone has been changing, things we've been talking about for the last 4 to 6 weeks, and I think we are seeing a major turnaround, even though at some point this rally is going to kind of roll over a little bit and take a breather and maybe take a sharp drop to the downside as it retests those lows. And if those lows hold, which I suspect they will, then the market is going to be going into a new bull phase, which is going to be pretty exciting after 2.5 years of watching our balance decrease almost on a daily basis.
Well, if you look at the equity markets, things like Google or Apple are very highly priced, and mining stocks probably the best bargain out there.
Well, in relationship to a contrarian bet, I think that's really true, because everybody that wants to get in probably is already in the broader market, but everybody that wanted to get out probably already is in the mining stocks. And so the key, I think, is to look at our positions and remind ourselves what a core position is and what a trading position is, sell some into great strength and buy some into great weakness. But a lot of times people will make a purchase, and if it goes up a little bit and then it goes down a little, they'll buy more where they had bought before, and they just end up doubling down, so to speak, rather than waiting for a larger drop, which may or may not happen, but at least if it does, they would be dollar cost averaging lower. So the key, I think, is one of the keys is not to get to the point where you're trading frenetically and you get caught up with the energy of the market, and your trading behavior looks the same as the market's energy itself, which can be really destructive.
Yeah, the old follow the other sheep kind of deal.
Right.
And we've seen that happen before, too, where the psychology of, well, if everybody else is doing it, I better do it as well.
The fear of being left behind. And so fear it has two heads. On the downside, you're afraid you're going to lose more and you want to get out. And when the prices turn around, you're afraid you're going to miss things. Now, it's very seldom that we have runaway markets. This is where the markets take off and don't turn around and look back. And those happen occasionally, and when they do, they're really historic type moves. And so we could be looking at something like that now, but I suspect the odds still favor that at some point when things calm down a little bit, these prices will level out, and then they'll establish a broad trading range, which could take a while to chew through that overhead resistance. People should remember that $1,900 gold and $50 silver is still a long ways away on the upside from where we are today, even though the prices have surged really in a very large amount, with silver being up $6 from the lows and gold knocking above well over $1,400 this morning, where it had been, I think, as low as about $1,175 or so only a couple months ago. So there are a lot of people that have sold, that will be selling into this rise because they have lost money and they want to get out. So I do believe at some point here next year, early next year, we're going to see that overhead resistance taken out in both gold and silver and new highs, but it won't happen by this time next week.
Well, examine how important it is to be patient if you're taking a look at the markets as a long-term investment. You're listening to HowStreet.com radio. We'll be back right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. My guest is David Smith, the senior analyst for the Morgan Report. David, we said patience before the break. Do people have to learn that perhaps when you have a good investment at a good price, let it play out? Don't just say, gee, it's gone up $6, time to bail.
I think that's really true, especially if you're looking at a core position, which by definition is one you would want to hold until you felt that the secular bull market was over. We've been experiencing a cyclical bear market, which has gone on for over 2 years, but that appears to be ending. And so it's easy to want to capture those profits and jump out and then go, now what, when it goes up another 50 cents? And I was looking at some of these share prices just a few days ago that were 25% lower than they are now, and it was tempting to just sell out and go, oh, wow. And then when you see it go up, then you do what next on the plan B. So you have to be calm, and you have to sell a little into strength, and you have to buy a little into decline. But otherwise, hold on to your core positions because you've waited long enough for this, and continue waiting until we see much higher prices.
I was surprised the prices stayed as low as they have for the longest time with such a demand for gold and silver in India and China.
Well, that's true, and the physical market is becoming more and more a factor in overriding the paper market, and at some point it would probably end up crushing it, but that's a ways off. But this is very fascinating, and we've talked about this for a couple of years. It's been a hard couple of years, and we're going to have more difficulties ahead, so it's not going to be salad days as far as you can see. People are going to have to be able to experience these declines when they happen and plan for them and look at what happened before so that they can recognize the signs that the bulls and the bears leave as tracks in the market when these things do occur.
The Pascua Lama mine sitting there idle, billions of dollars worth of gold sitting in the ground, will that ever come out of there, and will it ever make a profit?
Nobody knows for sure, but there are several big projects, mega projects, that have been stopped dead in the water or thrown back by many years due to all sorts of issues. And this is what's going to happen, I think, over the next 3 years as these presumed supplies don't come onto the market. And then if the demand continues as we've seen it for the physical market, that's going to make things even tighter. So it'll be reminiscent of platinum and palladium where they are now in a few years for gold and silver.
And speaking of platinum and palladium, South Africa, have they done anything to cure the long-term problem that's caused all the labor turmoil there?
None of the systemic issues have been resolved. My understanding is that this week that a couple of the big miners' unions there are going to vote on the strike if they don't get a 60% increase in their pay rate for the PGM mining. And the market can't handle that. These producers are already producing at a loss as it is. So that combined with the governmental policies and the cost of digging deeper to get these metals out of the ground means that the supply of PGMs is going to continue to be problematic. And I still believe that we're going to see an upside breakout in the PGMs well before we see the same thing happening in gold and silver. And how that behaves as people jump on and fear that they're going to miss the rally, this type of thing will give us some indications of what gold and silver will look like when they make their own breakout moves probably sometime next year.
Thanks a lot for chatting with us, David.
It's been enjoyable, Jim.
My guest has been David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can contact us at info@HowStreet.com. I'm Jim Goddard.